Today, we're going to look at the company Canadian Natural Resources, headquartered in Canada and traded on New York Stock Exchange under the ticker CNQ. Please stay tuned for the important disclosure information at the conclusion of this video. The story of Canadian Natural Resources is a definitive tale of growth from a small junior explorer to a global energy powerhouse. Originally incorporated in 1973 as AEX Minerals Corporation, the firm rebranded to its current name in 1975 and quickly established its presence on the Toronto Stock Exchange in 1976. For its first 2 decades, the company focused on building a steady asset base in Western Canada, but the late 1990s and early 2000s marked a transformation. Seeking greater access to global capital, Canadian Natural Resources listed on the New York Stock Exchange in 2000, setting the stage for a period of massive consolidation. A defining characteristic of Canadian Natural Resources' history is its strategic acquisition of long-life, low-decline assets. A major shift occurred in the early 2000s when the company invested heavily in the Horizon Oil Sands project, pivoting from traditional gas and oil toward large-scale mining. This evolution was accelerated by the massive acquisition of Shell Canada's oil sands interests in 2017 and Devon Energy's Canadian operations in 2019. These moves solidified Canadian Natural Resources' position as the largest independent natural gas and crude oil producer in Canada. Today, headquartered in Calgary, the company is recognized for its disciplined capital allocation and a remarkable track record of over 25 consecutive years of dividend increases, proving that a once small explorer could become the backbone of the Canadian energy sector. Canadian Natural Resources operates under a resilient, balanced business model centered on long-life, low-decline assets that ensure steady cash flow regardless of market volatility. The company's operations are primarily divided into 4 major segments: oil sands mining, conventional oil, and natural gas. By managing a diverse mix that includes everything from zero-decline synthetic crude oil to liquids-rich natural gas, Canadian Natural Resources maintains the flexibility to reallocate capital to the highest return projects as commodity prices fluctuate. While the vast majority of its production and reserves are anchored in the Western Canadian Sedimentary Basin, Canadian Natural Resources maintains a strategic international presence in the UK portion of the North Sea and offshore Africa, specifically Ivory Coast and South Africa. These international assets provide crucial exposure to Brent-linked pricing, which diversifies the company's revenue streams beyond North American benchmarks. Canadian Natural Resources' customer base is predominantly institutional, consisting of global downstream refiners, midstream operators, and industrial consumers. A major portion of its crude oil is sold to high-complexity refineries in the U.S. Midwest and Gulf Coast that require heavy feed bitumen blends. Recently, the company has pivoted toward the Pacific Basin, leveraging expanded pipeline capacity like the Trans Mountain expansion to reach new markets in California and Asia, including national oil companies in China and South Korea. Canadian Natural Resources has spent the last 20 years undergoing a massive structural shift in its revenue base. The primary narrative of this period is the company's transition from a conventional oil and gas producer into a global leader in oil sands mining and upgrading. This evolution began in earnest with the 2009 commissioning of the Horizon Oil Sands project, which introduced an entirely new, high-volume revenue stream of synthetic crude oil. Before this, Canadian Natural Resources relied heavily on short-cycle conventional wells and natural gas production, the latter of which saw its peak revenue years during the high-price environment of the mid-2000s. The financial profile of the company fundamentally transformed between 2017 and 2019 through a series of multi-billion-dollar acquisitions. By purchasing Shell Canada's oil sands interests and Devon Energy's Canadian assets, Canadian Natural Resources effectively consolidated its position as the largest independent producer in the country. These moves significantly increased the oil sands mining portion of the revenue table, providing the company with long-life, low-decline assets that generate steady cash flow even when prices are volatile. While conventional production and natural gas remain vital, the oil sands segment now frequently accounts for nearly half of the company's total annual revenue. Recent years have been defined by extreme market cycles, from the pandemic-driven lows of 2020 to the record-breaking revenue peaks of 2022 and the operational records of 2025. In 2022, the combination of high global energy prices and full-scale production led to a historic revenue high of over $42 billion. Entering 2025, the company has further refined its model by achieving 100% ownership of the Athabasca Oil Sands project, solidifying its revenue base around zero-decline assets. This two-decade journey reflects a disciplined commitment to building a balanced portfolio that can leverage infrastructure like the Trans Mountain expansion to reach global markets while maintaining one of the lowest break-even costs in North America. The financial trajectory of Canadian Natural Resources from 2006 to 2025 is a narrative of disciplined capital allocation and a strategic pivot toward long-life, low-decline assets that have fundamentally stabilized the company's cash flow profile. In the early part of this 20-year history, Canadian Natural Resources operated primarily as a conventional exploration and production firm, where revenues were highly sensitive to the short-cycle volatility of North American natural gas and crude oil prices. This is evident in the 2008 peak and subsequent 2009 dip, which mirrored the global financial crisis and the sharp correction in commodity benchmarks. However, the 2009 commissioning of the Horizon Oil Sands project marked a permanent structural change, introducing a manufacturing style of production that provided a predictable base for operating cash flow. As the company matured into the mid-2010s, its business model shifted toward consolidation. During industry downturns, Canadian Natural Resources leveraged its robust cash flow to acquire high-quality assets at opportunistic prices, most notably the 2017 acquisition of Shell's oil sands interests and the 2019 purchase of Devon Energy's Canadian operations. These moves effectively doubled the company's production capacity and shifted the majority of its revenue towards zero-decline mining assets. This consolidation phase laid the groundwork for the record-breaking financial results seen in 2022 and 2025. By 2022, a surge in global energy demand drove total gross revenue to nearly $50 billion, allowing the company to rapidly deleverage its balance sheet. The final phase of this 20-year history, spanning 2023 to 2025, is defined by the company's commitment to shareholder returns. Having achieved its long-term net debt target of $12 billion and recently adjusting this to $16 billion based on increased reserves, Canadian Natural Resources now operates under a policy of returning 100% of its free cash flow to shareholders once debt thresholds are met. In 2025 alone, the company returned approximately $6.3 billion through dividends and share repurchases, supported by an operating cash flow of over $15 billion. This evolution from a junior explorer to a global cash flow powerhouse underscores a 20-year journey of safe, effective, and efficient operations. Canadian Natural Resources has spent the last 2 decades evolving its capital allocation strategy from a focus on aggressive resource acquisition to a mature model of maximum shareholder returns. In the earlier years of this history, particularly from 2006 to 2014, the company's financial profile was characterized by significant debt-fueled growth as it built out the multi-decade Horizon Oil Sands project. During this build phase, dividends were a secondary focus, and excess cash was largely reinvested into the ground or used to manage a balance sheet that carried substantial financing debt relative to the company's size at the time. The 2015 to 2019 period marked a critical transition. Despite the volatility of global oil prices, Canadian Natural Resources maintained its 25-year streak of dividend increases, while simultaneously executing massive strategic acquisitions. The 2017 purchase of Shell's oil sands interests is the most notable entry in the acquisition column, causing a temporary spike in interest-bearing debt that the company has since systematically reduced. By 2020, despite the pandemic-driven downturn, the company's long-life, low-decline assets allowed it to continue paying dividends while many peers were forced to cut. In the most recent 5 years, Canadian Natural Resources has entered its cash flow machine era. Since 2021, the company has utilized record-high energy prices to aggressively buy back its own stock and pay down billions in debt. By early 2024, the company officially reached its long-term net debt target of $10 billion. As of the end of 2025, Canadian Natural Resources reported a record production year, supporting massive returns to shareholders through dividends and buybacks. This history reflects a disciplined journey from a junior builder to one of the most shareholder-friendly major energy companies in the global market. Canadian Natural Resources is currently led by Scott Stouth, who assumed the role of president and director on February 28, 2024. He is a veteran of the company, having joined the organization in 1997. Over nearly 3 decades, Stouth rose through various operational roles, including Executive Vice President of Field Operations and Chief Operating Officer for Oil Sands. His compensation structure is heavily weighted toward performance. For the 2024 fiscal year, he received a base salary of approximately $1 million. His total compensation reached roughly $9.4 million. The ownership of the company reflects a strong foundation of institutional confidence alongside significant skin in the game from its founders. Institutional investors currently hold the largest block of shares at approximately 70%. Individual insiders, including directors and senior management, own roughly 2% of the company. A significant portion of this is held by Executive Chairman N. Murray Edwards, who holds about 21.5 million shares, representing approximately 2% of the total equity. The remaining 28% is widely held by the public and retail investors, maintaining a liquid float that supports the company's dual listing on the Toronto and New York Stock Exchanges. Unfortunately, the liquidation value of the company is negative. Let's build a scenario-based dividend discount model. The future of Canadian Natural Resources is currently at a strategic crossroads, balanced between its role as a traditional energy giant and its necessary evolution in a decarbonizing world. The company's long-term outlook is fundamentally anchored by its massive, long-life, low-decline asset base, particularly in the oil sands, which provides a predictable production foundation for the next 30 to 40 years. An optimistic bull case scenario envisions a world where global energy demand remains unexpectedly resilient, potentially driven by delayed transitions or a slower-than-expected rollout of alternative energy in emerging markets. In such a scenario, Canadian Natural Resources could leverage its vast proved reserves to accelerate production through major expansions like the Jackpine mine. This would be catalyzed by sustained higher oil prices and a favorable regulatory environment that provides the certainty needed for long-term megaprojects. In a base case scenario, Canadian Natural Resources is expected to maintain its current trajectory of disciplined, incremental growth. This story is one of operational excellence, where the company leverages its existing infrastructure to fill the pipes and optimize margins through technological advancements like solvent-enhanced recovery. In this environment, the company likely sees steady single-digit revenue growth and maintains robust operating cash flow margins in the mid-30% range. Capital expenditures remain focused on sustaining production and high-return debottlenecking projects rather than massive, risky greenfield developments. This scenario assumes a stable global energy market where oil remains a critical part of the energy mix even as renewables expand, allowing Canadian Natural Resources to continue its 26-year streak of dividend increases at a sustainable pace. Conversely, a bear case scenario accounts for the real possibility of accelerated climate policies, carbon pricing, or a significant global economic slowdown that dampens demand. Here, Canadian Natural Resources would likely pivot into a harvest mode, drastically cutting capital expenditures to protect its dividend and focusing exclusively on its lowest cost, most efficient barrels to survive a low-price environment. In the bull case scenario, we assume the following: revenue growth at 5%, operating cash flow margin at 40%, capex growth at 6%, stock-based comp growth at 4%, dividends growth at 11%, stock repurchase at 9%, acquisition spending in the next 20 years at $25 billion. Stock repurchases assumes price-to-sales ratio of 2. After paying off debt, all available free cash flow will be returned as dividends. With this discounted at 7.5% dividend model yields in Canadian dollars $62 worth of value per share in 20 years, $85 in 30 years, and $98 in 40 years. In the base case scenario, we assume the following: revenue growth at 2%, operating cash flow margin at 35%, capex growth at 2%, stock-based comp growth at 2%, dividends growth at 4%, stock repurchase growth at 4.5%, acquisition spending in the next 20 years at $12 billion. Stock repurchases assumes price-to-sales ratio of 2. After paying off debt, all available free cash flow will be returned as dividends. With this discounted at 7.5% dividend model yields in Canadian dollars $39 worth of value per share in 20 years, $51 in 30 years, and $59 in 40 years. In the bear case scenario, we assume the following: revenue decline at 1%, operating cash flow margin at 30%, capex decline at 3%, stock-based comp growth at 0%, dividends growth at 1%, stock repurchase is discontinued, acquisition spending in the next 20 years at $5 billion. Stock repurchases assumes price-to-sales ratio of 2. After paying off debt, all available free cash flow will be returned as dividends. With this discounted at 7.5% dividend model yields in Canadian dollars $28 worth of value per share in 20 years, $33 in 30 years, and $36 in 40 years. Thank you so much. Research like this takes a lot of time. If you enjoyed it, please like, subscribe, and consider supporting us. Please note that this video is for entertainment purposes only. We are not financial advisors. This video is not financial advice and should not be considered as such. This video does not provide any recommendations and does not endorse any decisions to buy, sell, or hold any security. We do not guarantee the accuracy or the completeness of the data provided in the video. We are not responsible or liable for any decision, damages, or losses the viewers may take or incur due to negligence or otherwise, based on any interaction, directly or indirectly, with this video. Past performance is not an indicator of future returns. The viewers are encouraged to seek independent legal, financial, taxation, or other professional advice for any action they might take.